Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything that you need to start your trading day. Good morning, traders and investors. Welcome to this Friday edition of Benzinga's PreMarket Prep. I'm Spencer Israel, here with Joel Elconin and Dennis Dick. Got a jam-packed show for you folks again today. 3 guests on the docket. First, 8:15, we're going to be joined by Rob Freezen. He's the president of Bright Trading. At 8:35, we're going to have Brian Sheehy on the line. He's the general manager at TipRanks. They rank sell-side analysts based on the accuracy of their calls. And then at 9 o'clock, we're going to have Oren Kaplan on. He's the co-founder of Sharing Alpha. They do crowd-sourced fund ratings. So a good slate of guests today. We're going to talk about a few earnings coming in as well, and some ratings and some general movers. And we're going to learn how to correctly pronounce Nvidia is also on today's docket. Joel, how are we doing in the S&Ps?
There's something wrong. Could you get the tech guys over here? There's something wrong with my computer. The S&P futures are down. They're down. Thlike red. They're down a lot.
Joel, you give that joke every time we're down. Although we're not down that often, so we don't hear it that often.
Yes, but every time it gets me.
just like
S&Ps
really gremlins in Joel's computer.
Down 11.5 points at 51.25. Never saw the close last night at 6 p.m. Now we're bearing down on Tuesday's low at 49 even. It's only a couple points away. That's going to be an area of support. Under that, we get under the 2340 level. In the gold market, gold is trading up by $7, almost $8 here, right near the 1260 level. Flight to quality. Silver trading up 23 cents at 1834.5. And just want you to know the tech guys came over to check on my computer. So how's that for service?
Dennis?
Crickets.
Okay.
Crickets. More crickets. Continue.
Am I going to have to spend the
Uncomfortable
whole
silence.
Am I going to have to spend 3 days with you in New York? Is this the kind of treatment I'm going to get?
Yeah, lucky. Well, lucky for you that I got my own hotel room there, Joel. So.
All right, let's move on to the markets here, and we are trading in the red. What's going on? What's the big driver here? I see Apple down $1.28. Actually, all of the top components in the S&P are deeply in the red here. Is earnings the culprit?
No, I don't think it's earnings. I think it's just a little old-fashioned profit taking. The question is, can this be a sustained sell-off? Because we do not see sustained sell-offs anymore. Every time we pull back 10 points in the S&P, they come in buying with 2 hands. I said it earlier in the week. I don't know if it's going to be the case here. One of these times it's not going to be the case, but your culprit here this morning, I would say, is your financials. They are definitely weak here overnight. Your European financials, let's blame Europe here because Deutsche Bank is trading down 3% here this morning. So we got our Deutsche Bank indicator up. Let's go and look at UBS. It's trading down 1%, so not as bad. Barclays is down 2%. RBS, Royal Bank of Scotland, is down 4%. Maybe it's the culprit. So your banks over in Europe are very weak here this morning. And then let's look at our banks, and they are weak as well. JP Morgan trading down over $1. Citigroup trading down over 1%. Goldman Sachs trading down 1.5% here this morning. So those are weak. And then you look at your cyclicals. Those are weak as well. The only thing I see strong on my screen, which was strong yesterday, is gold. Gold is up here again, 90 cents on the GLD, and your gold miners are all trading higher here as well.
Todd Gordon did mention yesterday, he's like, gold's rallying, silver's rallying. A little fear in the market, so he wasn't, trying to call a top anything. But, hey, chat, throw a financial out there you want to do a technical look at, and whatever the first one pops up is the one that I'll take a look at. I got Goldman Sachs up here. Does anybody want to look at Goldman Sachs, Bank of America, JP Morgan? Okay, no takers. We'll go with Bank of America, the most heavily traded. 24.10, trading at the low of the pre-market session as we speak. Made a new high of the move here. We'll do Deutsche Bank in a second. To me, big number in my head for Bank of America. Don't think we're going to see it today. Is going to be 23.50, right, Dennis? That's the area that we broke out from. All those
60 cents down from here, though. That's a ways yet.
Okay. I was just thinking, man, that's my major area of support. 24 psychological level, but if I was to re-enter this thing on a long trade or I was looking to cover a short over the next 2 or 3 days, it'd be the 2350 to 2360 area.
I mean, it's not unreasonable to think it could get back 50% of this move. We were down at 22.50. We go up to 25. Cut it in half. What is that, Joel? Give us your error math. We know you won that grade
That's
6 math contest.
$1.50, 75. That's 24 and a quarter. Where you're going from the 23 and a half level. So
no, I was going from the 20. I was going from the beginning of the move in February, so the low of the recent move. So 22.45. I was going down to.
Okay, so that's.
I'm looking back on the 8th.
That's
we
2.5, buck
days.
and a quarter. So 22. That's 23 and a quarter. That's even below that.
All right, so that's where we're looking, 23 and a quarter, 23 and a half, if it does continue in a sell-off mode. But I don't sell anything short in the hole because we know what happens. The buyers and money managers say, oh, here's a great buying opportunity. We're down 0.4% on the S&P. I better jump in with two hands. I don't know. One of these days it's not going to happen, like we said, but today, who knows? Let's go jump over here to a couple other earnings plays here. Actually, let's go to, okay, so it's Nvidia. Nvidia, Joel. You got to say it right.
Or
Nvidia.
Or Nvidia.
You can say Nvidia. You can say Nvidia. You just can't say Nvidia. There's no N. It starts with N, but it's not N. It's N or what's the other one?
In or N?
I'm confused. Right. I got Nvidia. I'm starting to call it Nvidia because I see the N.
That's fine. That's fine. That's okay.
You know how
what was the other way though? You said the other way was okay.
Nvidia, but it's okay.
Well, I don't get how you get in from
It's okay.
So I'm not even going to go there.
Okay, you know how immature I am, so I'm going to consistently say Nvidia. So let's take a look at Nvidia. NVDA.
No, you can't say Nvidia. It's got to be Nvidia.
Because there is a company called Nvidia, a different company.
Right.
It would need to have like something else. You know why? Because it's spelled Nvidia. To say Nvidia, you'd have to have like an E in there or something. So Ace has been telling us about this pronunciation for a while. So it's Nvidia. Dr. J says Nvidia.
All right, we cracked.
No Nvidia. Dr. J doesn't like Nvidia. Nvidia. We're going with Nvidia. Dr. J says so.
Stock Hunter sold out at 1,109. That was a pretty good fill there, but 109 I think is what he made. So let's just look at the pre-market low. We just made a pre-market low in the issue, if that's better for you guys. In the issue, the pre-market low is 90.
The issue not to be named.
96.50. Let's see where this. See if we can find some support here. I call for the lower 95s today, maybe if you want to hang out. Oh, actually 96.60. We're trading an interesting level. That was your low on December 15th, and trading below the 96.60 level.
What's the catalyst here today? There was some director that sold some stock or something. Spencer, do you know what the catalyst here for the continued 3.5% sell-off in Nvidia?
This morning, I don't actually.
I thought I saw something running through my timeline about some director selling some stock.
I mean, yesterday morning we got comments from Andrew Left on Nvidia, but that was yesterday.
Is he still short?
He's $90 price target, didn't he?
Well, he just said that they're a good company, but they can't. The underlying business can't keep up with the stock price. But I don't have anything for you this morning that I'm seeing.
I thought I saw some director, and I might be maybe I dreamt that up in my sleep there. But chat, if you can verify there if I'm dreamt that or not. In any regard here, Joel, I got a question for you. When's the last time you saw two analysts take a stock that's so widely traded down basically, 14% from yesterday?
Unprecedented. Unprecedented. And
not like your little Mickey Mouse company, yes. Not a stock that's this widely traded. Sure, it was the double downgrade to equivalent of sell from BMO and from Namira, but wow.
Do you want me to go into my conspiracy theories or not? I mean, I won't.
Sure, we'll allow it.
I mean, it's just perfect timing. I mean, look, Namura hit it in after hours on Wednesday, right? Lower liquidity, right? And I'm not saying they had a position or any clients with a position, but if you're going to hit a stock, and you want to do it, it's like after hours or pre-market, right? So
Well, all your upgrades and downgrades come after hours.
some come during the day, but this comes
very seldom. 95% are going to be pre-market or after hours.
Okay, so you hit it there. So obviously less liquidity, and then let's say you just you're already short. I'm saying you're already short here, and you just come in with 5,000. You go 5,000 a buck lower, and then people lift you at 106.5. Then you pull your offer, and everyone scrambles and takes it up to 107. Then you go 5,000 at 106. They lift you a little bit. You pull the offer, they pop it up. You lock it down again. So the shorts just finally had their day. There was weakness. They took advantage of it, and then boom, and then the day traders and the algorithms get in on it, and then you get the other downgrade in the morning. But I have to agree with you, Dennis. Never have I seen two analysts move a big stock like that, and
not even two major analysts.
Exactly.
Nomura has a following, but BMO Capital, not to knock it, but it's a Canadian, so I don't know. I like BMO actually. Yeah, I do banking at BMO. My wife used to work at BMO Capital, but that being or BMO the bank itself. But I've never seen them have that influence of that.
No,
that's incredible.
No, and it really is, and I think it just shows just the temperament of the market too. Right?
It just gets a ball going in one direction. And once that ball starts rolling the other direction, everybody and their grandma wants to own Nvidia. And all of a sudden, you get a couple downgrades, everybody's scrambling and looking out. And it shows how, crowded the trade maybe was as well. I think, when you see a stock sell off that quickly, it's probably because there was too many people, too many short-term traders. And people will say, I get this all the time. What do you mean crowded trade? For every buyer, there's a seller. For every seller, there's a buyer. But it's all about where short-term order flow is. Longer term order flow, Fidelity doesn't care that Nvidia got downgraded, but your short term traders do. So, that's the difference. And it's all about where short term order flow. And if a lot of your stock is being held by short term day traders or short term, algorithms or, traders with a short time horizon, that's what I mean by crowded. And that's when those are the traders that are going to scramble. And those are the traders that are going to hit the bid to get out. It's not going to be your Templetons. It's not going to be your Fidelity. It's not going to be your long-term pension funds selling out of Nvidia because they got downgraded. So, that's what I mean. I think, we were in a crowded trade to the long side, and, people want an excuse to get out, and they got it.
Okay. All right. So we got 3 minutes before we bring Rob Freezen on. He's the president of Bright Trading. Let's cover at least another 3 or 4 stocks.
Well, let's cover an earnings stock. So let's go to Baidu, BIDU here. I reported last night, and this stock has been all over the place as well. It got hit, it rallied up, and then it got hit here again. Give us the numbers here for BIDU, Spencer. Are they in U.S. dollars or are we in Chinese yuan?
Yeah, it's confusing. So $1.91.
That's the bad thing about the numbers for Baidu.
Yeah.
Usually it comes in yuan.
Yeah, $1.91 cents. That may not compare to the 91-cent estimate. Sales $2.623 billion versus 2.67, so a slight miss on that number. They see Q1 sales at $2.374 to $2.45 billion. It's a little lower than the 2.47 estimate. And there you go.
And the stock was yo-yo here after hours. Jill, tell us about it.
Wow. The big range, 190.80 to 178.32. Just hanging out here, adding a 180 handle. So let me go to the daily chart and see if you can give some levels after that kind of range. Let's see here. We are trading at 182.32. I'd give myself some room on the downside here. 181. You had a double bottom, so if it takes that in the regular session, I see a lot of downside. Coming back on the upside, I'll just go with my own number, the close, 84.64 after that kind of whipsaw action. I'm sure people would love to see the mark at 84.64.
If you're trading Baidu, obviously keep an eye on Alibaba as well. A lot of people pair trade this together with Baidu, and you saw Baba popping around, and now it's dropping too with BIDU as well. So keep an eye on Baba. Could have a little bit of a sympathy move if the Baidu sell-off does continue. 8:15.
All right.
8:15.
We're right on time.
We're going to go grab Rob Freezen, president of Bright Trading.
Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by Benzinga Pro. I'm your co-host, Joel Elconin, along with Dennis Dick and Spencer Israel, and we are joined on the line here by Rob Freezen, a veteran trader and president of Bright Trading. Rob, how you doing on this Friday morning?
I'm not bad, thank you. Glad to be on your show. Appreciate it.
Rob, so let's just jump in, just tell us a little bit about Bright Trading. And obviously I've been with Bright Trading here for 17 years, and I think you've got me beat by at least a year there, Rob. So tell us about Bright Trading, how it got started, and what you guys do there.
Yeah, it was January 10th, 98 that I knocked on the door of Bright Trading in Vegas there.
You got me beat by a year and 3 months.
There you go. Listen to your elders then, right?
That's it. Well, tell us.
What our firm does is provide capital for traders to really further their career. Especially with the markets moving higher and higher, people find that they require so much capital to trade these stocks, and a lot of people move to options for that reason, as they figure they can have a better business in that area because of the capital demands. So that's where we really come in. Is we're an equities only firm, and we provide the capital for people to trade with. So if you're looking for multi-strategies over multi-time frames, intraday and overnight, we can be a great vehicle to further your success. There's three benchmarks that I've seen since I started in 1998, and I think they've been running since 1992. Do you want to hear what kind of benchmarks our traders strive for? Okay.
Yeah.
So we've seen 0.1% return on capital. So if a trader employs $1 million, for the day in various ways, 0.1%, 1,000 a day. Another one would be a penny a share. In fact, our profitable traders last year were about 1.4 cents a share net. So a penny a share net on average since the firm's been in business, 1992, is what we see. That means that it takes 1 million shares a month to make 10 grand a month. I mean, you've got to really be working at this business in order to make a consistent living. And it's not about the one-offs. It's not about the home runs. It's about that constant grind. What are you doing that's repeatable? What are you doing that contains that, slight edge you can just do over and over and over and over? So a penny a share has been consistent for traders for all these years through all kinds of markets, and that includes high volatility and low volatility. The trader has to adjust, obviously, but the theme there is fairly consistent. And then if you like pairs trading, different long-short combination stuff, we tend to think in terms of units of volatility. So a pair would have, a habitual volatility that can be identified with. So let's say you're trading Coca-Cola against Pepsi. That's a common pair we pull out just to say, okay, you could do this combination. And it had a volatility of 1 ATR a week. So it on average, or 1 ATR a day. So it averages that consistently, week after week. You get a pretty.
So ATR, Rob, just explain what ATR is.
It's a common term in all kinds of trading. Basically, it's derived from true range. So what is the true range for the day? High minus low, previous close minus low, or high minus previous close. So you take the true range for the day and you average it over n number of days. Traditionally 14 days to get an average true range. We take a look at it from a lot of perspectives. Just like correlation or co-integration, you would want persistence of. You don't want just a short, brief sample of, it tends to be correlated for the last 5 days. I mean, you could have two stocks that are completely unrelated be correlated over 5 days. But how about persistence of correlation day after day for weeks, for months, for years? So we have pairs that we identify that over the last 250 trading days have been consistent at $1 ATR or $2 ATR, and they're currently doing the same thing. So that the nature can be identified by the trader. Now,
And
if you have that predictability, right, you can go in and say, okay, what can I earn from this? So it would be unrealistic for a trader to try to learn or try to earn $1 per day if that was the volatility of the pair that they were trading. But $1 for the week, now that would be a much more realistic goal. It could be achieved by 5 trades, 10 trades, 1 trade, however the trader wants to structure it and finds the opportunity to do it. But it's going to be a harvesting of that volatility on a weekly basis. And so if a trader had 10 pairs that all had average volatilities of $1 a day, then conceivably they could make $4,000 a month from harvesting the noise from those pairs or the trading opportunities and setups from those pairs.
And what would you say the percentage of traders at Bright, of your traders are pair traders? Majority?
Well, if we were just to take a cross section of the top 10 traders, there's actually probably 6 different strategies that are going on over the top 10. It's not a consistent theme like everybody does the same thing. However, the one theme that's been consistent since about 2001 was when, 2001, I was trading mergers and then into pairs. A lot of the pair area I'm self-taught. Some I picked up from some of the other guys that were learning at the same time. But one thing that's been really consistent since then has been the top traders are hedged.
Yeah.
Okay, and that's an amazing opportunity then with Bright Trading as your vehicle, because if we're providing capital, 1 million, 2 million, 5 million, 10 million, depending on your account size and skill level, obviously. But if we're providing that capital, you can employ it in a long, short way. You can employ it in intraday and overnight swing trades. So you hear a lot about, retail mentalities, swing trades. Well, what about the market's interference in your wonderfully chosen swing trade on a naked basis? What about the market's interference in that? What about the news that's beyond your control, right?
Let me hop in here for one, Rob. Let me hop in here for 1 second. I mean, a great example here is what happened in Nvidia yesterday, right? You wait for a pullback, you buy it at the 106 area, which is good support. Actually, Anne Marie talked about that. And you started to get a bounce in it off support and then, a factor. So I just wanted to bring it in. There's something that, attests to what you're speaking about. You can't control the double downgrade in something like that.
Well, you can't, but you know what? There's probably a sympathetic reaction in the peers, and a person, could have offset some of that risk by, a peers match, or sometimes just an ETF against it. So it's not possible to control market risk entirely. It's not possible to control macro risk entirely. Well, we tend to have traders that are really averse to any type of macro or market risk. They tend to trade combinations that are, a common one I throw out would be Unilever. I mean, they trade 2 classes of stock, in the same company, right? So there is a tighter spread, obviously a different style of trading for that. So it moves all the way from like contractual pairs, mergers, all those kind of things to, commonly correlated or co-integrated pairs. So you have your range. You can embrace as much risk as you want. And there is a trade-off where if you embrace a little bit more risk, there's more reward. But it's also then if you continue to embrace more and more risk, you often have greater variance, which actually reduces your returns. So there is a sweet spot in there where you're betting your edge, or you're betting, half of your edge on a conservative basis. And we found that people that really manage the risk side have a more consistent pattern to their, to their trading They have months and even years where they never have, a losing month. Sometimes we've seen traders go for, weeks and weeks and weeks without a losing week, and sometimes days. I've had, streaks of massive consistency with traders, but only in the area of hedge trading, and I have not seen that duplicated in naked trading.
Because the naked trading, you're exposed to market risk. I mean, you're coming in here this morning and the S&Ps are trading down 10 points, and if you're naked long, you're getting hit. But if you're hedged, just for example, like I was short Wells Fargo, but I was hedged with JP Morgan, so I'm looking at my Wells Fargo position and I'm down $300 in Wells Fargo, but I'm up $300 in Wells Fargo, but I'm only down $200 in JP Morgan. So, the hedge there is saving me by being short Wells Fargo against my JP Morgan position.
Right. Well, another thing I want to bring up is just okay, everybody looks at a buy side market, especially when we've, had a big rally since election day. And they look at that and they go, man, if I could have just done more long trades, if I could have, just rode things. And they always think that the money's made that way, and they fail to realize what the structure of the market is, how the market participants interact, and what type of premium is constantly being paid by the buy-side industry. And they fail to see that since election night, a great deal of money has been made on the short side. In fact, I probably have traders that have made the bulk of their money, if not all their money, on the short side. And they go, how is that possible? How is that possible that you can make money from the short side when the market's just been going up and up and up and up? Well, that's because of how the funds and the money managers participate, and what your role as a professional then would be to facilitate that need and facilitate that greed and facilitate that buy-side industry. Somebody's got to be on the other side. So are you skilled enough? Are you aware enough to harvest that opportunity? And that's great in pair trading, because a lot of times you can put one side of the pair on first and then match off only if necessary. So let's give an example. We've had many days where the market opens up at a pretty solid premium and then pulls back a little bit, and then later on it goes back up to continue its journey, right? Well, so you put some shorts out there for the opening, and if you need to, you hedge off, and if you don't need to, guess what? What happens, Dennis?
Oh, you just come in and you bring in your profits on your shorts.
Right. So, if you need to hedge off, you hedge off. If you don't need to hedge off, you just leave it, let her ride. And so people fail to see that how much can be made from the premium, of the buy side industry. The money chase, right? The anxiety and all that, especially when markets are going up. Tremendous anxiety. We're underdeployed. Our shareholders are angry, or blah blah blah, and it goes on. So there's a role for the professional, for sure. And that's where we come in. We provide capital for you to, take your $50,000 and now use $1 to $2 million of our capital. So you can do more strategies, and it's no different than the McDonald's business, in my opinion, right? I know McDonald's is a real estate company, yes, but it's also been a hamburger flipping business. And they didn't start off with soft ice cream and apple pie. They started off with a hamburger. And they added products as their business grew. And a trader needs to do the same thing. You need a good base strategy that's repeatable, that's compoundable. They can do it every day and grind out money and do the boring stuff that needs to be done. But then they can add on some extra strategies and maybe even some sizzle and pizzazz along the way, as they're better capitalized and as they're more comfortable and confident in a career. So you can end up with a full menu if you want.
And Rob is going to be, if you want to hear more from Rob and Bright Trading, and for me and Joel, we're all going to be at the New York Trader Expo this Sunday, Monday, and Tuesday. Tell us, just quickly, what you're going to be talking about at the Trader Expo, Rob.
Well, I'll have a little kiosk. We don't spring for the big glitz and gloss and snake oil and all that stuff. We just got a little kiosk, so you have to find us down there somewhere. on the exhibit hall. And then I think 3 o'clock on Monday, 3 p.m. Eastern time there on Monday, I am talking about something. I think the topic is related to, what's this about a proprietary, trading company? How can that benefit me? How can that further my career? How can that be the vehicle to ride? And I also want to bring in, a focus on long, short strategies as well, just to because it's not talked about a lot. How to touch a lot of symbols in a day. How to maintain market neutrality or even macro neutrality. So I want to bring that into my presentation. So I have about a half hour there on the main stage. So come around and join me if you're in New York or you want to quickly zap a flight out there and participate. It's free to attend the expo, but there's a lot of content, and you can pick and choose all your speakers and stuff like that. But I'll just be on the main stage for 30 minutes there.
We've been on the line with Rob Freezen, president of Bright Trading. If you have any questions about the firm, you can email robfreezen@brighttrading.net. Rob, always a pleasure. Looking forward to seeing you in the Big Apple.
Looking forward to seeing you guys.
Thanks, Rob.
Thanks for having me. Appreciate it.
Dennis, I think he made several great points there, but I think the one that you can attest to, the most is that over the years, I mean, how many different strategies have you employed? How many different news sources or different things that you've traded and to do it? And I think that's a great example of being nimble, not only in your trading but in your strategies and being open-minded to trying different things.
Yeah, I mean, so many different strategies. What I was doing in 1999 is completely different from what I was doing today. I was providing a lot of liquidity, doing a lot of, basically market making, and that's what you were doing back on the floor back in the day too. I mean, most of our floor traders, and most of the traders at startup right back in 1993 were market makers, and we've adjusted our strategies, and now we've kind of gone into what I would call statistical arbitrage, and you can call that, pairs trading would be one example of statistical arbitrage, and it's kind of evolved from there. And and the big thing, I take from Rob, and that I've learned at Bright Trading is I trade market neutral. That's the one thing, and that's how I've been so consistent over my years. And I've said that before. I haven't had a down month since 1999 in my trading. So literally, I've went, I don't know how many months that is, but we're talking about 17 years that I have not had a down month in my trading. And that is just because I'm trading market neutral all the time. So these big market crashes don't get me. I'm taking advantage of little market inefficiencies. I'm taking advantage of these different relationships. When they get a little bit out, I put the one side on, and I put the other side on as well. So I'm living proof, that when you're trading market neutral, it increases your consistency and becomes more like a business as opposed to make 1,000, lose 1,000, make 1,000, lose 1,000. I'm always just trying to grind out my living there, and I've been lucky to be able to do it for 17 years.
All right, 8:34. Let's cover one more stock here before we bring in our second guest of the day.
Yeah, so just jump over back to the earnings parade here, and we'll talk JWN because we heard from the Gap, or we heard from the Gap as well, but we also heard from Kohl's and Macy's, and now we hear from Nordstrom there. And Nordstrom always benefits because they're late reporting in the cycle, and it seems like when Macy's, gets hit, well, Nordstrom might get a little bit hit on that, and and obviously Macy's beat this time, but in any regard here, it seems like Nordstrom always benefits by being late to report, and I don't think the report was great, but it wasn't that bad. And we've had some bad reports from some retailers. So Spencer, JWN, what were the results?
Well, the Q4 EPS was good, $1.37 versus $1.15. Sales was not, $4.2 billion versus $4.35. They see their fiscal year adjusted EPS at $2.75 to $3. $3.05 was the estimate, and they see their fiscal year sales up 3 to 4%.
And stock trading up about $1 here in the pre-market. The only thing, the worry here is because we saw Macy's rally and then give it back. We actually saw Kohl's rally and then give it back. I don't know if it's going to happen the third time with JWN, but I'm cautious here because we've already saw two other retailers report, get the pop, and then the subsequent drop.
I think longer term here, I'm just keeping an eye on, let's just call 46 even. That was your 2-day high of 46.13, so that's a big level. During this rally up here, you did hit a high of 46.47 coming off the low, but you've only posted one close over $46. That was the same day at 46.12. Coming on the downside, you don't need a rocket scientist to see the institutions lining up here under 42.50. And just above it, you had a series of three lows between 42.32 and 42.62. Targeting the 42.50 level on the downside. All right, 8:35. Take our second break. Brian Sheely, TipRank's General Manager for North America. We're going to talk some fintech.
Welcome back, traders and investors, to Benzinga's Pre-Market Prep. I'm Spencer Israel here with Joel Elconin and Dennis Dick, and we're on the line with Brian Sheehy. He's from TipRanks. He's a general manager over there. Brian, how's it going this morning?
Morning, guys. Doing great.
Great. And
what's cooking here?
Not much is cooking. We're just talking about the market here. Brian was at our FinTech Awards last year. I believe you TipRanks won an award, and I hope you'll be there again this year. But tell us a little bit about TipRanks and what you guys do. I know we use you guys at Benzinga. You're a pretty good source for analyst information. So tell us about TipRanks. I'm not sure if our listeners have heard of you guys before.
Yes, of course. Basically, we use big data techniques. That would be natural language processing and machine learning, artificial intelligence, to scour the internet for expert opinions on the stock market. So that would be sell-side analysts and financial bloggers primarily. You know, the analysts would be the guys at places like Morgan Stanley, Goldman Sachs, making buy, hold, or sell calls on the stocks that they cover. The bloggers would be people you find in places like Seeking Alpha or Motley Fool or even Benzinga. And we find these people, we harvest their opinions or their ratings, we date stamp them, and we essentially paper trade their calls and create a profile on each one of them and essentially a batting average. We calculate their success rate, how many times their ratings or their opinions make money versus lose money for investors, their average return per rating or per article. And then we tell you who actually makes money for you, who's worth following, and who you should probably ignore. We also, in addition to the analysts and bloggers, we track the performance of corporate insiders and hedge funds and their trades as well. So we capture four types of experts. We create mathematical batting averages for each, and we tell you who the real experts are. And then we also, of course, tell you, who the top performers are and what they're recommending, what they're trading today, and what stocks are trading according to that sentiment data that we create. That's the basis of what we do.
I didn't realize you guys were actually paper trading these calls, but the reason that I know people at Benzinga use you guys is because you provide a good just overall scorecard of how analysts are doing in the past, and so that's how we use it, because we talk about this on the show all the time. Is analysts chase price, analysts pile on, and it's easy to bash them when that happens. But sometimes analysts do make amazing calls when they go out on a limb, but it's hard to know that, right? It's really hard to keep track and hard to remember when an analyst made this call and what happened afterwards. So that's why we use you guys, and so I'm wondering if there are any observable trends that you've seen since you've been with the company with regards to specifically analyst ratings, but it could be in general, because we talk about this a lot. But are there any give us some advice or something about when it comes to tracking analyst or analyst behavior, analyst ratings. Give us a tip for how we can do that.
Well, over time we've found that, like everybody knows, a lot of analysts are sort of biased to the upside. You see a lot more buy ratings than sell ratings. But we have found there's a core group of analysts, about 15%, that consistently rank at the top in terms of their performance and typically outperform the market consistently. And you can go into our website, and one of the things you can click on is the top 25 Wall Street analysts. You can see exactly who those guys are. You can click on their profiles. You can see their full coverage of stocks. You can click on any particular stock, and you can see a chart showing the stock price and exactly where on that chart line they made their calls, their buy or their hold or their sell ratings, and what happened to the stock price as a result. And we can actually show you their performance on a stock by stock basis. So, for instance, you typically read in the press that Goldman Sachs, puts out a buy on Facebook today. Well, which analyst at Goldman Sachs actually covers that stock and made that call? We can allow you to drill right in and see who that person is and see what their track record is on Facebook or all the other stocks that they cover. We can even allow the viewer, the investor, to choose the time frame over which the performance is measured, whether that's over 1 month or 3 months or a year or 2 years. We can even show you how their performance stacks up against the S&P 500 as a benchmark, or as against a benchmark based on the sector that the analyst covers. So we can just allow you to drill into a lot of detail and really, cut through, the information that doesn't matter and hone in on those guys that really do consistently outperform and see exactly how they do it.
So when you say an analyst has, like I say, 89% success rate, what exactly does that mean? Does that mean that their target was hit?
No, price target is part of it, but that's on the buy, hold, and sell rating. So that means every time they issue a rating on a stock, we count that as a hit. Well, like a batting average, you count it as an attempt. So if a guy like, for instance, Gerard Cassidy, RBC Capital, we have captured 149 incidents where he has made a rating on a stock, and 132 of those times the stock price either went up if it was a buy rating or went down if it was a sell rating. So his success rate is 132 out of 149, or 89%.
Gotcha.
Then we also show the target price as well and show you how the stock price has performed against the target prices over time. But the primary way we measure these people is on the number of times that their calls turned out profitably and the average return per call. In the case of Mr. Cassidy, it's over 37% average return per rating if you were to paper trade that rating from the day he made it over the following 1 year.
Gotcha. And now, is your service free?
Parts of it are free. We basically have a freemium model. So at the free level, you can see who the top 25 analysts are. And you can see some limited statistics about them. You can see a limited amount of analysts covering each stock. But if you really want to drill in and see all the full details, then you have to subscribe at either the premium or the ultimate level. Gotcha.
And now, so are there any other observations you've made with regards to analyst behavior? Have you observed what we have, and I'm sure many others have, that analysts, they take what happened with Nvidia yesterday? We get 2 analysts, a double downgrade on the stock and hit it. So I'm wondering if you've observed anything like that, and how closely you track these guys yourself on a personal basis.
Me personally. Yeah, there's about 7 or 8 analysts that I follow, and I've had pretty good luck, following the stocks that they're rating the highest. And that's really the beauty of it, is you can drill in and you can see which analysts or which bloggers, for instance, are consistently making the right calls. And in the case of Nvidia, we captured 3 ratings yesterday. One from Ambrish Srivastava at BMO Capital, downgraded Nvidia. Stephen Smidgy at Raymond James has a buy rating. He reiterated it yesterday. And Ramit Shah at Nomura downgraded yesterday as well. But all three of those analysts you can see on the Nvidia page are 5-star analysts, meaning they consistently outperform the rest of them.
We're on the line with Brian Sheehy from TipRanks. Joel, I think you had a question.
Yeah, just going back to the fintech awards last year. Could you give us any highlights, and also if you're in attendance this year, what are you looking forward to checking out this year?
One of the most interesting trends I see in investing, and in a lot of other industries as well, and I think it's fascinating and maybe a little bit scary at the same time, is the progress of artificial intelligence and machine learning. With investing, you have these robo-advisors coming out with programmatic, very sophisticated programmatic ways to manage investments and mitigate risk and maximize return, all done by computers now. And you even see a lot of the bulge bracket firms sort of adopting that technology, more aggressively in order to compete. In fact, I read an article a couple days ago on LinkedIn that, suggests perhaps artificial intelligence eventually could replace these stock market analysts and do their jobs for them faster and better and more thoroughly and more efficiently. It's really fascinating. I'm hoping to see, what different players in the market at the event might be taking advantage of these types of techniques more aggressively and more efficiently, like we are, and the kinds of creative products that are going to come out of that.
All right, Brian Sheehy, General Manager at TipRanks, thanks so much for joining us this morning. I'm looking forward to seeing you at the FinTech Awards in New York on May 11th.
Thanks, guys. My pleasure. See you there soon.
All right, have a good one. All right, always great to have people who are at the awards on our show. Let's get back to the market that we've covered a handful of stocks today. But
I was going to say that's interesting in itself, though. Like, he's following the analysts so close that he knows their track record. Like, that's something that I've never really considered looking that deep, to see, what is this guy's track record? Or he's got a really good one. Is he more influential than other ones? I just see, Nomura. So, that's a, pretty major firm. But you start digging right into the specific analysts, and if they have a really good track record, maybe they're more influential. Because he said on Nvidia that all of those guys were like 5-star analysts, so very influential analysts.
That's exactly it. So I do know that we use it. We use TipRanks on the desk for that exact purpose, right? To seek out analysts who are influential and to see their track record. Anyway, let's get back to the earnings. We haven't covered JCPenney yet today. JCPenney reported Q4 adjusted EPS of 64 cents versus 61 cents. Sales $3.96 billion versus 3.98. So they beat on the EPS, they missed on the sales. They do expect to close 2 distribution facilities in the next few months. Says it'll save them about $200 million in costs annually. And as far as guidance goes, fiscal year adjusted EPS of 40 cents to 65 cents. That is in line with the estimate. They're also going to close up to 140 stores.
Can we officially say that the JCPenney turnaround story is over, Joel? Because, multiple times in 2016 you saw JCPenney rally from like $7 up to over $10, and every time it gets back up there, all of the analysts and everybody on CNBC saying, yeah, JCPenney's turning around. I think, then the dust has settled here. This is just a company that's in a world of hurt. And, when you're closing distribution centers, you're trying to cut costs to save money, and you're closing stores and trying to save money. That's not the, spot that I want to invest in.
All right, let's first I want to talk JCPenney here, the specifics of the technicals. Pre-market low 653. That's going to be a big level coming into play here because you had a trio of lows right under right at the 640, 650 area. So that's the only area of support I can identify here. You go into rally mode. The close was 686. I'm sure a lot of people would want to see the mark as well. But Dennis, let's just talk overall retail here, right? I mean, you have the Amazon effect. You have you can say there's a noticeable downtrend. I mean, you can always try and pick bottoms in these things and, try and get rebound rallies. But, I mean, for the most part, you can't say Amazon's going to eat everyone's lunch. But, just it's just avoid. I mean, I know both you and
Yeah.
I have neither of these stocks in our portfolio. I mean, what's going to turn to, all right, Macy's may get bought out. Okay, you can own it. You got to pop. You look at something like J.C. Penney. You look at Kohl's. I mean, these are just ugly charts. And that,
Yeah.
there's a reason we've missed out on some upside by not having these stocks in our portfolio. But on the other hand, you just don't experience the headache. So, I mean, I think it's just overall, it's just kind of a sector call.
I mean, it's about, saying, are you in this for a trade? Are you in this for an investment? I mean, anything is tradable. And I will trade anything. And at certain points in time, J.C. Penney has been a good trade to the long side, and maybe today's going to be one of those days, who knows? I mean, even looking at it here, and I come in here and short J.C. Penney as a trade? Well, no, because I've seen a lot of retailers bounce on decent earnings, so you got to use that as a tell. But when you are just looking at, do I want to come in here and invest in J.C. Penney at $6.65? Completely different question, completely different story. That's when I'm going to jump into the fundamentals. That's when I'm going to look, what is this company doing right? What are they doing wrong? When you are trying to save money by closing stores, that's not, my idea of doing it right, and this is a company that's in trouble when they're, that's a sign that you're in. That's why, from an investing standpoint, I don't want any of this stuff. And, they're all been the same thing. Macy's was going to close stores. They're all hurting. They're not, the revenues aren't going up. So they got to, there's two ways to make money. One is, to drive the top number up, but the other one is to drive the middle, the bottom, to drive your expenses down. And that's how they're trying to do it, because they can't drive the other number up. Whether it's Amazon, whether it's consumer trends, I don't know what it is. But retailers have been struggling here for a long time. And I'd imagine Amazon has a lot to do with it.
All right, Spencer, we got a few more earnings to cover, right? How about the disaster stock of the day, ACIA?
Yeah, ACIA reported yesterday after the bell. Q4 adjusted EPS 94 cents versus 90 cents, which is not bad, but sales 142.4 versus 139.72. So not bad on the Q4 numbers, but they are getting killed this morning. I think that's on the guidance.
Down 17% here. The algorithm again says guidance is more important than earnings. So here you go, ACIA falling hard, and this has just been ugly for a while here now. I mean, we go back to a year ago, you go back to the summer of 2016, and we're up over $120 a share, actually up to 128. Now we're $52, so this stock has actually, been cut more than in half now. I don't really follow the company fundamentally, so I can't tell you, if it's getting, relative valuation, getting cheap. All I can tell you is that the chart is not pretty.
All right, hard to pick a level here. I'll just give you your pre-market low. That's 52.27, and you are not far off that level. So maybe some more work to do here on the downside. When I go to my monthly charts and longs, you're not going to want to hear this at all. There's a lot of air in this stock, all the way down to 39.29. Go to your daily charts. I'm sure you can find some intermediate levels in between if you're thinking of covering the short in this one. Not sure I would advise much on the long side today.
Hewlett Packard Enterprises, so we're talking HPE now. We talked HPQ yesterday because it had a good earnings report and got a big lift. That's the legacy business, the printing business. This Hewlett Packard Enterprise, more the services business when they spun it off. And the service is not doing as well here, Spencer. Stock's down 9% in the pre-market. Tell us about HPE earnings.
Yeah, I'm surprised. I would have thought it'd be the other way around, but Q1 adjusted EPS 45 cents versus 44 cents. Sales 11.4 billion versus 12.07. So not a great Q1 number. As far as Q2 goes, they see that as having adjusted EPS of 41 to 45 cents. 47 cents was the estimate, so they missed that. And for as far as fiscal year EPS, $1.88 to $1.98. 210 was the estimate for the fiscal year adjusted EPS.
Again, guidance hitting it, and the stock had some expectations. It ran up ahead of the report, and boom. And here you are, and this is the one thing, why when you're holding into earnings report, you're holding technical trades in earnings report, you could be in trouble here. And, the stocks run up for 2 weeks, or actually 3 weeks straight from the 22.5 area. And in one day, boom, it gives it all back. So, you look at it and, a technical analyst will say, well, you put in a double top. But I mean, really, this thing is moving on fundamental information.
All right, looking at the pre-market low, and we just hit that at 22.38. If I was shorted, I'd be bringing it in here. I see a pair of lows at 22.26 and 22.37 from the beginning of February. And if you don't want to cover there, maybe hold out for under 22, a pair of lows at 21.84 and 21.99. Dennis, just to attest to you, talking about the printing aspect, I could not be happier with Hewlett Packard. Now we got a new printer, and they read my cartridges, and boom, whenever they get low, they send me. And I mean,
do they? That's
yeah,
cool.
and I paid nothing for it. I mean, I think I pay. I don't even know.
They give the printers away.
Yeah,
because they want to get you on the ink.
But the cartridges are really cheap too, and they don't send them unless you need them.
How much are cartridges?
I haven't been to the store and buy them in a long time. I couldn't even tell you. I think So I think I pay maybe $8 or something whenever they send it to me.
Per cartridge?
Yeah. Yeah.
That's really cheap because and they're like $20. You go to Staples or you go and, I buy mine at Costco. You can buy the whole package of them there. And I think it's like $50 for my 5 ink cartridges. But, it's the inconvenience of going up there. And then you still, you're still paying $10-12 a cartridge there too. I know some people refill them, but that's too much work. So, wow, that's interesting. It's convenience. So, Hewlett Packard trying to figure stuff out.
Actually, I think it might be $8 a month. So that's $96. And I know that I spend, between the printing that, Lisa does and I do and stuff, my cartridge costs would be far in excess of $96.
Yeah, it depends how much you print, I guess. So, it's a service plan you're on, which is kind of cool. They do that. Let's jump in balances. We only got 3 minutes here before our next guest. We got a lot of selling balances here today, which obviously with the S&P futures trade down more than 10 points, you knew that was going to be the case. The banks littered with selling balance. This is your weak sector here, guys. We've got Bank of America again. This is the 4th day in a row, 428,000 to sell. Some institution has been correct with all these selling balance out the morning because Bank of America obviously has been down for a few days here as well, so they've been lightening up. Citigroup 112,000 to sell. Wells Fargo 143,000 to sell. Goldman Sachs only 15, Morgan Stanley 67,000 to sell. HPQ, not talking HPQ actually 316,000 to sell. It's trading down probably because HPE is getting hit here today and had the big pop yesterday. Colgate, which is a stock that has been rumored to be in play, stock has been popping and popping while it's dropping here today, maybe a little bit of profit taking. It's got 136,000 shares to sell. That is substantial, and that's knocking the stock down the pre-market. Square, which had a great day yesterday, SQ really popped up. It's got 220,000 to sell, so you got some institution taking some profits there as well.
All right, I was looking at some of these intraday charts and stuff, and Square did have the higher open, but man, if you try to get out right in front of that open and short it, you got mowed down because. And what I've been seeing here is a little bit of a trend where, they. Like within the first 7, 8, 9, 10 minutes, they just shake everybody out that's shorted. I mean, sometimes you see a minute or 2 minute bar, and then that's it for the day in some of these stocks. They have a 1.5, 2 minute, $1.5, $2 range, first 2-3 minutes of the trading, and then the day's over.
And that's, why, at the open, I'm always focused on trading, where I really focus because that's where your most volatility comes in. That's where price discovery is, and that's where I'm participating, and that's where, I make my most money. So, you can, if you're right at the open, it's, sometimes you can buy a stock at the low of the day, or you can sell stocks short at the high of the day, where, because a lot of stocks open at their low of the day or open at their high of the day. So there's, a big event there. It's where the opening cross happens. You have a lot of people, where they're, jumping on that opening trade. So it's very relevant. And that opening range, that opening bar is often, like you said, as big as, the sometimes entire range of the day.
All right, S&P's near the low of the session. We are trading down 11.5 points at 23.51 in a quarter. Pre-market lows real close here, 50.50. Tuesday's low, which stands as the low of the week at 49 even. So that looks like the first area of support. Well, Dennis, we're going to let you go here. We'll check in with you in a little bit later, but we're going to interview Oren Kaplan. He's the co-founder of Sharing Alpha, and we'll be right back, talk a little bit more fintech.
Remember,
Welcome back, traders and investors, to Benzinga's pre-market prep. I'm Joel Elcon, along here with Spencer Israel, and we are joined by a person in the fintech industry. That's Oren Kaplan. He's a co-founder of Sharing Alpha. Oren, how you doing? I guess I can say, since you're in Israel, how you doing this evening?
Thank you for inviting me. I'm doing fine.
All right, before we go into your product and the FinTech Awards, can you give us a little bit of your background in the markets and why you started Sharing Alpha?
Sure. So I have to go back about 20 years now. I've been involved in this industry since then, and the idea behind Sharing Alpha basically came as a result of my personal experience investing in funds that did really well before I invested, and it was no longer the case after I put my money in. And this is something that a lot of investors are experiencing nowadays, and that's why a lot of them are going and buying more and more ETFs. It basically drove me to do some further research on how I'm doing fund selection, what can be done, how can I improve on that. And I found a lot of papers that actually prove that using past performance indicators to look at how funds have performed in the past is not a good indicative value. I don't think that will be a big surprise to a lot of your listeners. Although that's the case, although a lot of people know that looking at past performance is not an indication for future results, it's not just a disclaimer at the bottom of the fact sheet. Many investors still use those ratings and those indicators in order to select managers, while the research has proven that using qualitative analysis, actually going and speaking to managers, looking at their active share, looking at different other indicators, adds much more value. Probably the issue behind that is that there are over 100,000 different funds globally, and it's very difficult to cover that amount of funds doing qualitative analysis, and that's basically the reason why many of them are using quantitative analysis, which is much more handy and easy to produce. Although again, it doesn't add value. On this background, we basically looked at how other industries cope with situations where there are over 100,000 different products or services. How do they analyze this amount of data? How do they select products in a better way? And the way it's done nowadays, as many of you know, is using platforms. The likes of TripAdvisor and Yelp are very popular, and that's what we've basically done. We've developed a platform called Sharing Alpha that basically invites investment professionals to come and to rate funds, and we're just a technology provider. We make sure everything works, and we calculate the average rating that they provided. So that's in a nutshell the background behind Sharing Alpha.
When did you have this bad investing experience with the funds that prompted you to embark on this endeavor?
Well, during my career, I've come across this anomaly, I'd say. I mean, there's in total, there's over $100 trillion invested with active managers in different products. Okay. Mutual funds is about 40 trillion. And when you think about it, I mean, it's this size of the market. You think that people will be able to select products in a better way. So it's something that I've been thinking about for many years now. I've come across many managers that have become superstars, and everybody's been following them and investing in their funds. And then years later, they were at the bottom of the pile. It's very Again, it draws into this frustration that it's very difficult to select a manager in advance, especially if you're only limited by looking at his past performance numbers. But there is proof that qualitative analysis does help, and there is a better way of selecting managers. There are ways of doing it in a better way. It's just that the way the market is structured at the moment, that each fund selector or advisor works separately. They work in silos and they don't join together and share the information. Doesn't basically enable the advisors or the end investors to have that kind of information and to select managers in a better way. So that's why this is so useful.
How do you qualify someone? Yeah. How do you qualify someone to be a contributor on your site?
Yeah. Okay. So there's two vetting stages. One is that we make sure that we identify the rater. It's not like on the Financial Times called us Morningstar meets TripAdvisor, but there is that similarity that I mentioned, that it's a user-generated rating platform. But there's the difference where on TripAdvisor, anybody could go and rate and influence the rating of a hotel or a restaurant. Here on Sharing Alpha, we only take into account ratings coming from professional fund selectors. So we have to identify them and to see, what do they do during their day job. If they're dealing with fund selection, then fine, we take them into account. That's the first stage. And then there's a quantitative kind of screener that we use where we basically rate the rankers. So the people that rate the funds on our website, unlike TripAdvisor, we're actually able to rank them. If somebody rates a fund 5 stars, believing the fund will significantly outperform its benchmark, we can later on follow the actual performance of the fund. And if there's a match, if the fund really did outperform its benchmark, then the rater receives a high ranking from the Sharing Alpha platform. That's actually the motivation for them to join and to rate funds and to share this information, is that we enable them to build a proven track record. So advisors, investment professionals can come on our website and build a proven track record that they can later on exhibit to potential clients or to their existing clients, and build up a career to themselves, exactly like a fund manager can build up a track record and use it later on. So this ranking that they have, is useful in order to motivate them to come, and there's hundreds of them that have already joined and started building up a proven track record. But the other use of that is that we don't use an equally weighted average of the different ratings that we receive from these professionals. We give extra weighting to advisors or to selectors that have a high ranking on the Sharing Alpha platform. So if you're right with your predictions and you end up with a high ranking on the Sharing Alpha platform, your ranking will count more than somebody who just joined and doesn't have a proven track record on our platform.
Oren Kaplan, co-founder of Sharing Alpha, talking about evaluating funds. Oren, we hope to see you out at the FinTech Awards. Thanks for joining us, and we'll see you in May.
Thank you very much.
All right, folks, we're going to wrap things up here at 9:10. S&P futures trading at the low of the session. 23.49.50 is your low. Just remember, 49 even was Tuesday's low. Also, Dennis and I will be at the Traders Expo on Monday and Tuesday, so we'd love to see any of you people that are in the area. I know Ace is cleaning out his slate for the next 3 days, so he can attend. So hope to see some of you traders and investors out there.
And again, that's at the Marriott Marquis in Times Square in New York City. All right. Have a good rest of your day, everyone. Hope you enjoyed this week's slate of shows. We'll be back with you on Monday. I'll be here in Benzinga HQ. I'll be in the studio. But Joel, Dennis will be from New York, so we'll do the show, and it'll be great. Have a good weekend, and we'll be back with you next week.
Whether you're a short-term swing trader or a long-term investor, you need to check out Thinkorswim, brought to you by TD Ameritrade. There's a reason why Thinkorswim has been named the #1 trading platform, because it has it all. With Thinkorswim, you can trade stocks, options, futures, forex, and virtually every other type of order. Get notifications on mobile devices and interact with other traders in chat rooms. You can also use technical indicators and see the latest investing and trading education in Think Money magazine. If you want to keep up with the markets, you need Thinkorswim. To experience everything Thinkorswim has to offer, open a TD Ameritrade account today. Thinkorswim, the online trading platform for traders and investors. TD Ameritrade, member SIPC. All investing involves risks.